You're watching Stockwatch this week. I'm Ntaoleng Lechela, and joining me to unpack your stock-related questions today in studio is Chantal Marx from FNB Wealth and Investments, and via Zoom is Devin Shutte from the Rogue Bay Group. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392, or on X at Business Day TV using the hashtag Stockwatch. Chantal, Devin, thanks so much for your time this afternoon. And Chantal, thanks for coming into studio. We love it when you're in here. Let's start off with, tracking market developments, right? So markets still focusing on the Middle East, and we recently heard from the White House that the Trump administration said they'll make a decision in about 2 weeks on whether they'll support Israel in launching strikes in Iran. Does this provide some sort of comfort for markets as the 2-week period leaves some room for diplomacy, negotiations to take place?
Yeah, I think certainly that would be a good thing, but it also just delays a decision, which means that uncertainty is kind of perpetuated during that 2-week period. And don't forget that on the 9th of July, we also have the 90-day tariff reprieve coming to an end. So a lot needs to happen in the next 2 weeks, and I think that markets will reflect that through volatility.
Devin, let's get your view on that. I mean, I have even forgotten about tariffs for a bit, and Chantal just brought in that important deadline that is approaching.
Yeah, look, I mean, it's just incredible what investors have had to, I guess, deal with and, try work through the complexity and the uncertainty that we've had this year. It's felt unprecedented, but I mean, I'm sure we always have lived through things like this. So yeah, the tariff's still coming up. There's a lot still undecided. I know the Europeans are now negotiating with Trump and looking to do a similar deal as the UK. But I think the real issue to my mind, or the real tail risk, is this conflict in the Middle East. Just because it's impossible to kind of model this geopolitical risk. And, a good barometer of that is the oil price. You saw it spike up massively yesterday. It's dropped $2 today with this kind of two-week wait and see what the U.S. administration is going to do. But the reality is that no one knows. And, I think escalation is what the real concern is here. If the U.S. does step in, what does that look like? And so the long answer short, we just don't know, and I think investors are on the edge of their seats as a result.
And just on that oil price then, Chantal, are we also not seeing sustained gains in the oil price because there hasn't been any real disruption or direct hit to the Strait of Hormuz?
Yeah, I mean, I think if you look at supply and demand fundamentals in the oil market, it's an oversupply. Yeah. So I think that gives it a natural downward movement, and that's why we saw it at quite low levels for quite a while so far this year. This spike is basically saying to us that there's a risk that we could have a disruption to supply that then results in the balance moving the other way. And it's twofold. It's the Strait of Hormuz, and then the second story is if it becomes a wider conflict and potentially you get supply disruptions out of big oil producing nations like Saudi Arabia and Qatar. I think that's where this spike comes from. But in terms of the actual impact on the ground right now, we haven't really seen any disruption in terms of oil supply. And that's why you're also seeing it move downwards quite dramatically at times as well.
And just on the back of that oil price, we also saw Sasol making gains as, the oil price has surged. I think at some point it was even trading above 100 Rand. And when last? Right? I spoke to Grant and Devin last week, and they shared their views on the counter, saying it's one for a riskier investor. Do you share the same sentiments? Because we have a viewer here asking if the worst is over for the counter and whether they should buy Sasol at these levels.
Yeah, so I mean, from my perspective, I think it really has become a trading stock. 10 years ago, it was a core portfolio holding. It was one of those stocks that you had in your core portfolio and you built the rest of your share basket around it. But now I think it's become a trading stock. And a big part of that has to do with the volatility in their pricing. Operational issues that they're facing that they still haven't sorted out fully, and real concerns in terms of feedstock supplies going forward. I mean, they need to have something to convert into liquids in order for them to actually have something to sell. And at this point in time, we're unsure about gas supply. And even on the coal side, they're trucking in coal or railing in coal because their own mines can't produce what they needed to produce. So as long as they don't solve those issues, I think it remains a trading stock in my view, and a trading stock that you can make a lot of money in, as we've seen over the last couple of weeks.
And Devin, you haven't changed your thoughts around Sasol, right?
No, I think still the same. I think Chantal made some great points there. Look, it's not for the faint-hearted, but I mean, the stock was trading under 60 Rand not that long ago. And we've reached 100 recently. So I think the tick up in oil prices has been one of the tailwinds for that. But yeah, the balance sheet still concerns me. There's still a lot of kind of environmental concerns. And just generally structurally doesn't look particularly strong at the moment. So yeah, I think a trading stock is a good way, unfortunately, to describe it at the moment.
Now, while Sasol benefits from the higher oil price, there are some inflationary concerns seeping through. How concerned are you about those inflationary pressures, Devin, particularly when it comes to risks associated to the higher oil price? I'm thinking about the Fed meeting this week. Yes, they raised their expectations for inflation, but they've pegged that just on tariffs.
Yes. So, I mean, it will depend on, how these tariffs play out. Is it just a once-off price spike and then that kind of gets baked into the cake and it no longer has the impact on inflation? Or does this kind of create a perpetuating cycle where high prices beget more high prices? I'm not too sure. I think the Fed decision was understandably hawkish. I think what was very interesting is if you looked at the dot plot, which was where the governors kind of see, the rates trajectory going, I think you saw a kind of a broadening out of where some of the governors saw things. So the median still stayed about the same for 2 cuts on the Fed for the remainder of this year. But I think there's an increasingly concerned element within the Fed that thinks we may not get any more cuts this year. So I think I'm watching that kind of dispersion of opinion there within the Fed. And as a result, it ties back to what we were talking at the front of the program. It's just increasing uncertainty. Fed feels they should wait. Growth looks to be slowing significantly. Inflation doesn't look to be running away at this stage. We haven't seen evidence of that. But it's also not coming down as fast as they would like, whether it's core PCE or CPI. So yeah, a lot to watch, and unfortunately, a lot for investors to keep their eyes on all at one time.
Yeah, and certainty really remaining the name of the game, Chantal. And let's bring that inflation conversation back home, right? We saw inflation figures this week steady at 2.8% in May, but zooming in on the print, we are seeing food prices increases, and offsetting that was the fuel price, declines in the fuel prices. And with that oil price in play, we've seen some economists even pegging fuel price hike in July, something I guess Governor Kganyago will be very concerned about.
Yeah, I mean, I think that it becomes a concern if oil prices remain elevated for a while, because then you can get a situation where it starts filtering through into the rest of the economy and it starts appearing in the prices of other goods and services. And then you really get a push up in core inflation. For the time being, I think core inflation is quite contained. And the main reason being that demand locally still seems to be quite soft. That can change if the oil price stays elevated for a long time, particularly if it is combined with a weaker rand. Now, I don't think the rand is that weak yet. It's actually held up reasonably well for a very volatile, high beta currency relative to the US dollar. But if we get rand weakness combined with elevated oil prices for a while, you can start seeing that coming into the inflation story. What I would also just mention around inflation is we would probably expect, we actually expect it to start ticking up, and that's outside of the oil price story.
I think even the SOB did mention that in the second half of the year we will see a tick up to around that 3% mark.
Absolutely, and that's just base impact because we had pretty high inflation at the start of last year, and it faded quite nicely into the second half of the year. So as we're approaching the second half of the year, our base is a little bit less demand. So it will naturally just tick up as well.
All right, let's get back into some of the questions. A viewer asking Devin why retailers have been dropping this week, and the viewer would also like your analysis on Mr. Price. I guess maybe we are just seeing downbeat sentiment, and that probably also weighing on the retailers, right?
I think it's possible. I mean, I presume they're referencing clothing retailers specifically, but we can chat about food as well, which is, I guess a lot more stable. Our clothing retailers, by and large, I would say have been pretty impressive this year. I think we saw some weakness end of last year, but I think now they're really starting to kind of find themselves. The recent round of results that we chatted about before actually really showed some nice margin gains in a lot of them, some nice market share gains, and I think really getting their product mixes right. So, short-term volatility with this week, I wouldn't see too much into it, but we are seeing kind of the quality of the some of those clothing retailers come through, which is terrific. And also you've got to remember that structurally, or let's say the South African economy is still kind of perceived by investors as, structurally flatlining. So any improvement to that will create a nice tailwind for these counters, because they're managing to grow earnings despite no macroeconomic growth. So I think that, but I would say, to kind of sum up all of that, the risk is to the upside to them. I think they're executing well. I think they managed to fend off the online competition quite nicely. It's not going away, but I think they've managed to find their own place there. And so, as a result, we're constructive on the sector in general and some of the counters in specific.
So Devin saying short-term volatility, and we will be seeing tailwinds going forward for that sector. Is this a sector you like? I mean, we looked at Mr. Price results, TFG results, really, really good numbers. And TFG in particular, those bash numbers where they broke even ahead of schedule. Seems like a really strong sector.
Yeah, I do think that there are some tailwinds for the sector. I mean, we did see the two-part story really helping them at the end of last year, and probably in the new tax year as well. We saw that coming through in retail sales numbers. But I think outside of that, you do have inflation being quite well contained. We have seen above inflation wage increases in the SA economy over the last year. Even though employment is still very weak, we have seen a tick up in the absolute number of people employed in South Africa over the last year. So that those things do act as tailwinds. Lower interest rates also perhaps helping consumers. Just some breathing room in terms of taking up more credit. A lot of these guys are credit-based retailers as well, particularly in the clothing space. So I mean, I'm quite positive on TFG, on Mr. Price. I think Pepkor are doing really great things. I think it's a buying opportunity in Clicks at the moment. That share has been pushed lower as well, and you don't very often get an opportunity to buy Clicks. And then even the food retailers, I think that Shoprite in particular continues to execute well, and there's opportunity in the current weakness that we are seeing.
Let's start with you, Devin, and we're looking at the food grocers. A question here, the viewer asking, is Pick n Pay a buy at 25 Rand, or should I just buy Boxer at 66 Rands?
Yeah, it's a great question. I mean, maybe I'll start with Boxer first, just to say, what an incredible retailer that is. It's stuck to its knitting all through the years, and really was the lifeline that saved Pick n Pay with its IPO. So we like Boxer. So then coming to Pick n Pay, should you be looking at it? It's not a very high quality company for a number of reasons. Got very low margins, hasn't been investing much in the business. But what is interesting is its stake that it has in Boxer. And if you look at what the valuation of Pick n Pay is at the moment, and compare it to the stake that it has in Boxer, it's virtually like for like. So you're getting the rest of the Pick n Pay operations virtually at nothing, which to my mind is quite interesting. In addition, they're also looking to convert some of those loss-making Pick n Pay stores into Boxers, and they're well into that process. Sean Summers is staying on until 2028, and that's when they believe that they're going to return to profitability. So it's not a foregone conclusion, but I think if kind of summarizing my thoughts on Pick and Pay is you're getting very cheap access to Boxer, which we like, and if you get the turnaround in Pick and Pay that Sean's trying to achieve, I think that's just going to be the icing on top of the cake. So yeah, an interesting proposition for sure.
And let's stick with, the IPOs that we saw last year, Boxer being one of the big ones. We also saw We Buy Cars. The viewer here says the only two new listings with so much hype in 2024. He then asks, We Buy Cars is doing well. He missed the train on the Boxer IPO. So he'd like to know, for the next 3 years, where should he put most of his money, in We Buy Cars or in Boxer? Two different businesses, clearly, but looking for value.
I'll perhaps start with why they were hyped up. I think they are very well-known brands in South Africa, and South African investors become really excited when they see stocks list in companies that they know. So I think that both of those were hyped up, and also both of them were executed in order to save the parent, right? We Buy Cars was transaction capital and Boxer was Pick and Pay. And both of these counters are very high quality and they are doing very good things. I always like it when a company puts out a pre-listing statement with ambitious forecasts and they actually end up meeting and exceeding those forecasts, and both companies have done that. I don't think it's an either or. I think you can own both of those companies. In terms of valuation, I think Boxer is probably fairly valued at the moment. So if you're a long-term investor, I'd still be quite happy. We Buy Cars is a little bit on the expensive side at the moment. But I think, again, it will grow into its valuation. It's a stock that's growing earnings at 20% a year, and you're looking at about an 18 times forward PE, which I think is okay. It's just a lot more expensive than it was a few weeks ago.
Yeah. And your thoughts around We Buy Cars, Devin?
Look, it's been a great success story, and I welcome any additional investment opportunities for rand-based investors. I agree. I think it is a high-quality company. It's had a really, really strong run since the beginning of April, going from almost doubling, which is just quite something in this environment. I think possible, we've liked the model, but possible things we're starting to consider that may slow that growth, I think is the fact that, remember, they came in and they disrupted that used car market massively. Yeah. They increased the velocity of sales cycles in used car market. The client experience was just far superior. You didn't feel like you were getting ripped off the whole time. But you've got the new car entrants from the Chinese manufacturers really kind of storming onto the market. That may slow down used car sales somewhat. And then also just the question on quality of their stocks. I know they do the DECRA reports and all of that, but you could argue, are the inspections as thorough as need be, and are the buyers getting cars free of any obvious problems? So I'm not saying that affects the whole business, but I think that could just sour things at the margin. So if you've got a company that's full from a valuation perspective, that might be cause for pause. So we like it, but probably just looking a bit expensive at this stage.
All right. So Chantal, are you seeing value in Libstar? The viewer says that the update was quite good, reporting a 10% increase in the first 5 months of the year, and they've attributed this to an increase in volumes, right? Now, that share price also hit a 5-year high on the back of that update. Are you seeing value there?
Yeah, I mean, I've actually seen value in Libstar for quite some time, and I've been very disappointed with the share price. And
isn't it at like 3 rand?
Yeah, I mean, and it's also been it's been very volatile. It's been up and down, and we've been. The results have also been up and down. So we've had a situation where the management team said, okay, well, we're going to start combining some of these businesses. We're going to try and extract some efficiency gains out of it, because it was very siloed when it first listed. They were going to narrow the portfolio. They've started executing on that. And I think we're finally at a point for Libstar where we can see the results of the efforts of management, and they're also receiving some really solid tailwinds externally. So it seems as if demand for their products, both on the contract manufacturing side and for their own products, are picking up quite nicely. I think the consumer is probably in a slightly better position that's aiding that. But yeah, I mean, I like Libstar. Even after the 16% increase in the share price yesterday, it's still trading on a 5 times forward PE. And that's without analysts having increased their forecasts based on this really strong trading update that we got on Thursday.
And are you seeing, the price at 3 Rand and some change, a good entry point for Libstar, Devin?
I'm less positive on the counter. I mean, I think it, had an acceptable trading update. I think it also wasn't quite comparable in terms of the period. I think it was 21 weeks versus 20 weeks. So that was probably flattering in terms of the growth in turnover. Yeah, I mean, from a valuation perspective, looking good, decent yield on it, but I'm inclined to, I'm not too sure that the portfolio is as compelling as it could be. There are others in the market, maybe the likes of a Tiger brand that I think are probably more entrenched with a wider consumer base, so would tend to favor those. So yeah, I mean, I think it's worth monitoring, but I don't think we're rushing in and buying it just yet.
And that was going to be my next question, where you're actually seeing value in that sector. But you mentioned that you are seeing value in Tiger brands. Tiger brands something you like, or is it a bit on the expensive side?
No, so I mean, I think that with the recent share price activity has been very positive, and it has been based on a very good set of numbers that they put out a few weeks ago. And they also seem to be moving in the right direction in terms of cleaning up the portfolio and delivering to investors something that they can understand and that makes sense to invest in longer term. So I think execution has been key, and they've shown that they're executing. So yeah, I like Tiger brands. Is it a little bit on the expensive side? Probably. But I can see them also growing into their valuation.
All right, I want to get into the education space, but we don't have enough time, so I'll get into your stock picks. Devin, I'll start with you. Where are you seeing opportunity today?
Sure, and there's one we've chatted about before, one we really like, listed in Hong Kong, Anta Sports. And this is the leading sportswear retailer in China. Not as well known in the developed world, but it's the third largest sports manufacturer in the world, behind Nike and Adidas. Got some great brands behind it. I think what we like is that there's a really long growth runway for the stock. Per capita sports consumption is rising around the world, but particularly in China, and that's in a really still quite a depressed consumer environment. I think they have turned the corner there, but they're still a long way from kind of the heady days before the property sector put a dampener on that. So yeah, we're expecting consumer sentiment to improve and Anta to be a direct beneficiary of that. Got a great e-commerce platform as well as brick and mortar stores, strong balance sheet, and yeah, we think it's a great way to get exposure to the Chinese consumer.
And what about you, Chantal? Are you seeing opportunity here at home or internationally like Devin?
Yeah, I actually had 2 stocks that I was debating here at home. The one being Super Group. They paid that special dividend in the week and the share price was down by 50%, suggesting a slight re-rating in the rump that was trading at like a 2 times PE. It's probably trading at a 3 times PE now. Their management team has been buying into the stock now aggressively as well, and that's always a good indication in terms of what the management team is thinking from a valuation perspective. So that was one. And then the other one that I actually ended up settling on, we've already covered. It's Libstar. So I think it's an opportunity. It's early for them in terms of their turnaround story, their portfolio cleanup, as well as their focus on some of the core businesses in Libstar. But the update that we got, even though not fully comparable, the fact that we are seeing decent volume gain and the ability of them to push through decent price increases as well, I think is a good leading indicator of what's to come.
All right, let's leave it there. Thanks so much for coming into studio. And Devin, thanks so much for joining us this afternoon. Chantal Marx from FNB Wealth and Investments and Devin Shutte from the Robey Group. Do remember that Stockwatch pre-records on a Monday and Wednesday at 1 p.m. and is live at 6:30 p.m. on Tuesday and Thursday, while Stockwatch this week is live at 12:30 p.m. on Fridays. Keep that in mind and keep your questions coming. For now, that's all from Stockwatch this week, but do stay tuned for lots more coming up right here on Business Day TV.